Evening, Jan. I hope you're well. And Jat, can you just check to see that you can hear me okay, etc.? Yes, no, indifferent. Hello, Anthony, Leo. All good. Brilliant. Okay. Well, I'm just setting things up, guys. Getting ready for it to come on top of the hour. Got a couple of minutes. Let some people drift in. Hello, Mr. Trading, Jeremy. If you load up your questions, I'll get to them as we go through. So don't worry. If I miss it, we'll get to it. I'll just scroll back because I've got one question I want to start with, and then we'll jump into yours. Okay. So let's have a look. See where we are. Andrew, good morning. I have a question. How to determine what power currency you're going to trade, and you analyze it. All right. I think I know what you're talking about. Are you talking about how I determine the strength? If you just clarify, and I'll touch into that, and I'll show you a way to do it. Hello, Ben. Good stuff. I do try and help. Hello, Chris. What I'll say about my channel is it's slightly different than most. I do swear a lot. I do get off on a rant every once in a while. And I'll tell you for why. Because everything you see is in the moment. It's never scripted. The guys in the squad will certainly tell you that. I tell them what I'm doing. I switch the camera on and then off we go. And what you see is what you get. And I don't think I can be any fairer than that. Some like it, some don't, but so what? Got my beer, and it's Sunday night. So let's have a look. Chris, breath of fresh air. Well, they're a breath of something. I think YouTube's it's a strange place, as is forums, etc. You either love it or hate it, and if you don't like it, don't watch it, sort of thing. But I often find that the ones who hate it the most watch it the most, which I find is quite a strange paradox. And I did see that today in the 5%ers presentation. There was a guy causing Murray hell, and all that was running through my mind all the time was, why are you here? You clearly don't like it, so back off. But hey ho, hey ho. Hello, Peter and Ben. You're so true there, Ben. There you are. It's such an odd paradox, because for as much as they think they're hurting you, they're actually not. They actually help you. Oh God, the redneck's in. Hope you're well there. Hope you're well there, Yox. Keep your chin up, kid. Keep your chin up. All right. Well, we're getting on to the top of the hour. So, guys, what we're going to talk about tonight is very simple. It's an open Q&A. Pretty much ask me what you like, and I'll try and answer it in my strange way. Will I swear? Definitely. Will I have a drink of beer? Most definitely. But will I try and help you? I'd like to think I can. Okay. So what we're going to do is I'm going to quickly answer a question from one of the guys in the squad, Mark. I'll salute you. And I picked your email up this afternoon, and I did respond to it. But I kind of want to clarify what I meant by it. Now, in his email, I'll give you a quick gist. He was asking about Where the Scruff. Now, Where the Scruff is a set of 43 modules I put together for the squad to understand trading. Now, within it, there is 3 main strategies plus a couple of sub-strategies inside it. And it can be overwhelming because sometimes when you're looking to trade, you're sort of helter-skelter. You're here, you're there, you're everywhere. But really, you want to concentrate on one thing. So get a foundation of what you understand. In other words, make certain your levels are correct. You understand how to draw your fib in correctly. Fibs are very important, guys. They're a mathematical ratio in a random arena, and the amount of times those two cross is unbelievable. I'll draw some up for you if you want. And then pick something that you like to get into the chart. So as the great Bruce Lee would say, I don't fear the man who knows 10,000 kicks. I fear the man that's practiced one kick 10,000 times. So the essence of that is understand one thing, but understand it and master it, and you'll be fine. Okay, so happy days. Now I'll touch on to something from the 5%ers as we go, but before the questions from Andrew disappear up the top of the chat, I want to answer it before it runs away. So let's segue that back a second and have a look. Right, Andrew, good morning. How do you determine the power of a currency, and how are you going to trade? Are you going to analyze different? Right, okay. I use a spreadsheet and I work out the strengths myself, which is kind of unique to me. The way I do it is unique to me, and it's something I don't really share because, well, there's a number of reasons. One, I don't think a lot of people would get it the way I do it. And other, it took me years to develop to just give away. And also there was an arsehole a couple of years ago, fucked it all up for everybody, and it'll never happen. But primarily, it's because I don't think anyone else could read it but me. But the end result is a strength meter that shows me the strongest and the weakest. Now, there is a way you can do it without doing the sort of mathematical gymnastics that I do on a morning. Now, if you bear with me, I'll show you the website. Flick this over. I shall find it for you, boys and girls. I shall find it for you. Because I wasn't working on that one. Where's it at? Give us a second. Finviz. Okay. If you come and find this website, Finviz, this'll do pretty much what I do on a morning. Now, the idea of the strength sheet, and I'll show you it if you guys want to see it in a second, if you just sort of shout. Come to Forex, and you have the same scale down here. Now, what we're looking at here is a heat map. So you can get a snapshot of the market up here. But if you want to decide which pair you want, you look at the opposite ends of the scale. So here, the US is the weakest, pound is the strongest, and if you want to change your strength, just keep a record from one day to the next and you'll be able to see where they are. So that should change your strength. And if they're moving, well, say that's weak today, but tomorrow it's about here, you know it's gathering pace, that sort of thing. That can be your pair, as long as that is 2 times greater than that. And you can see that by the little indents here. So all you need to do is just count 2 indents up. 1, 2, run across. Well, that's definitely 2 stronger than that. That's your pair. What does that tell you? It doesn't tell you direction, guys. It'll tell you movement. It'll tell you that a chart is going to move on the given day. Now, if you want to see mine, just shout and I'll show you mine. I'll show you how I read it. If you bear with me, give us a second. I might just show you it anyway, actually. Give me a second. Click that back. Now, this is a one that I use. It pulls out roughly the same figures. Now, I do this for the squad every day. Or I should say I share it with the squad every day and drop it into Twitter, things like that. What it essentially does is it collates all the data, works out the strongest and the weakest over multiple time frames, and it's the waves, it's a couple of indicators, they all together. I mean, the engine on this thing is massive. But I put it together and it spits out these numbers. And what they are, it'll tell me what the strongest is of the day, the weakest is of the day, and the change of strength from the last direction. From there, it's calculating which of the majors are the strongest. Now, it would say in there if they are. If it highlights a chart, it means that, okay, but there should be something in here to represent saying it's good, bad, or indifferent. You'll see that from time to time. This side tell me whether it's gaining strength, losing strength, or whether it's swapping direction. So it helps me gauge what's going on. And then in here, it'll pick out which are the best currencies to look at in the day. So all it is a giant filter. And then this side tells me the average ATR over the last quarter and the best chart to look at to analyze. And if I know what chart I'm looking at, I can work an anchor. I can go +1 up to get an idea of what's going on. I can go ±1 down to get an idea of whether that trend is in motion. And if it is it ready to trade? And that's the way we go. And that's what I use that for. It's a simple sheet, but it works for me. Some people like it, some people don't. They think it's overcomplicated, which is why this could probably help you. So I hope that kind of strangely answers that, oddly. So let's have a look, see where we're up to. 𝗖𝗢𝗡𝗘𝗖𝗧, you're still alive. Good lad. Good lad. Keep your chin up, kid. Keep your chin up. Okay, Anthony. How many currency pairs are manageable? You touched on it, and if 14 pairs is definitely right. Okay. You can look at all 28 pairs. It's not an issue. I do with that sheet. That's actually what that sheet was designed to do. But is it manageable on a daily or a couple of day basis? No, not really. What I do is I drill it down into 3 products. I think 3 on a daily basis is about as many as you need to manage it properly. And when I've spoke to the guys in the past, and so certainly if you're just starting out and you haven't found your consistency levels yet, jumping from product to product can actually be very dangerous, because you don't get in tune with the market. You don't get in tune with yourself either. Different products have different characteristics. Yes, they all go up. Yes, they all go down and go nowhere. But some are faster than others. And if you can't deal with the speed of movement, you sort of get yourself all confused. So I would say 3, but have 3 that are correlated closely together. Case in point, think about your own domestic indices. Now, for me, I live in the UK, so that would be the FTSE. So what's correlated to the FTSE in a currency pair? Well, that's the pound. So what's the best pound currency pair? Pound US, cable. It's one of the biggest. So the pound is driving the FTSE. We now got a nice pair we can work with, which is cable, pound US. So is there a third that I could use as well? Well, think about something that's correlated to the US that can actually be a risk on, risk off, and that's gold. So you've got FTSE, cable, gold. What that'll do is it'll focus your mind into just 3 assets. Those 3 assets should be able to give you at least 1-2 trades per day, which is enough to feed you. But also, because they're correlated in such a way, if you see moves in one, there's a fair idea it's going to move in the other. And I'll give you an example. If gold spikes, say it spikes up, there's a high probability that the US dollar is going down. So if US dollar goes down, gold goes up, and vice versa. Well, if the dollar's going down, well, doesn't that give you a heads up on cable? Means you can start looking at cable and think, well, there's a high spike on gold, but I don't want to trade gold today for whatever reason. But that big spike is going to ripple over into cable. Well, if you look at cable and you've missed it, and you think, bugger, I've missed that, it's happened there as well, it'll ripple over into the FTSE, and that's what it does. It bounces around. So you can watch all 3 and use them as early warning systems on the other 2 currencies. But if you're trying to look at 28, you mind will be blown apart. That's kind of my principle. I work to 3 and then I drill it into 1, and then I'll trade that single asset till I'm paid, and then when I'm paid, I'm gone. That's it. And that's kind of my edge to a degree. Am I a great trader? Not really. Am I a patient trader? Sort of. But am I disciplined? Definitely. Because I know when I'm done, I'm done. But if you're not disciplined, you think you're riding a wave, you go back in and you lose. And losing something that I kind of want to touch on as well. I think it's very, very important. Now, I don't know if you saw 5%ers sort of little seminar this afternoon about the new programs that they are doing. They brought out what essentially, well, I'll show you. Have I got it here? Yeah, I do. Give us a second while I figure this out. Going off on one again, boys and girls, going off on one. Right, where's it at? Wrote it down. Okay. I pull this up. Got the high stakes. This is what I'm after. This bit here. I don't know if I can blow it up. Can you see that? You should be able to see that. What I want to draw your attention to is this daily pause here of 3%. Okay. Now, what that's representing is a safety net. It's a genuine safety net for you guys. And when I was watching the chitter chatter this afternoon and it was brought up, there was an immediate kind of backlash against it to a degree. And they're going, oh no, this is stifling and one thing and another, and it's cutting traders. It's not. It's there for a very, very good reason. The amount of traders that will just pile on, and then their account is gone is unbelievable. So what it's doing is it's kind of a set of emergency brakes. You're going into trouble, stop. Now that raises another question. I'll be interested to see what you guys say in the chat about risk profiling. You know, now there's a difference between investing into a trade, which is what I do. I don't believe in risk. I genuinely don't. And when I hear people talk about risk reward and all of that, because of my business background and the way that I came into this, I just think they're talking out their arse. You know, they genuinely are. Because the market has more chance to go against you than it has for you. And my theory is very simple. You start in the middle, 1-to-1, but then you stack the odds in your favor. Now, if you watch the video I did yesterday about Scruffy Madness, trying to explain that, I showed the maths behind it, and it works fully. But think of it this way. Why is the industry so heavy into this sort of 2% risk and 1 in 3 and everything? And everybody's brainwashed into it. But think about why it's there in the first place. Because who tells you this? It's normally somebody who's going to sell you something. And the best sales pitch in the world is, well, you're shit at your job, but I'm going to pay you anyway. No. If your hit rate is under 50%, you're gambling. You're not very good at the job. So you have to ask yourself, why am I not very good at the job? And 9 times out of 10, it's because you over leverage the account, where the position's too big, so you blow it that way. You over trade, so you blow it that way because you can't outwit the market that many times. Or your risk gets out of hand. No, 5% has recognized that, and they decide to do something and put some brakes into it. So to me, I think it's a wonderful thing. It's a great idea. But the gamblers of this world don't. Maybe I'm wrong. Tell me. Ask the questions. All this is here for you. It's an open Q&A from what you say in the chat. If you don't say anything, it's going to be a very quiet session. But that's my thoughts. But think about risk profiling. And here's something for you to think about. Does anybody actually do a risk profile? No. Or I'll put it another way. Do you actually know what one is? Well, it's very quiet, so I'm saying no. Well, I'll tell you what mine is. I work around budgets and numbers. Now, a risk profile, if you're going down the route of the 2% and one thing and another, which is about right, but again, it comes down to terminology and how it's explained. Now, a risk profile for me is an allotted amount of money I'm prepared to put on the table per week. Now, that is roughly 10% of the entire account. So for argument's sake, if it's a £100,000 account, I have £10,000 of allotted investing money this week, all right, which equates to 2% per day, not trade, per day. So that £10,000, obviously 5 day a week, divide it, gives me £2,000 a day of allotted money. Now, if I make 3,000 on the day, well, I've got another 1,000 that I can add to tomorrow. If I lose some money, it's fine, but as soon as I hit 10,000, that's it, game over for that week. So if I lost 10,000 by Wednesday, I can't trade anymore till the Monday. That's a risk profile of budget, and it's the quick and easiest way to look at it. And it's dead simple. Just allow yourself a monetary amount per week, divide that monetary amount by 5, which will give you your daily allowance. And then if you're trading sort of once or twice a day, well, if you lose it all on the first trade, you're buggered, you can't take the second trade. Protects your account. Does that make sense to you lot in a quick way? Yes? No? Indifferent? Maybe it's not. Okay. Very, very quiet. Very quiet tonight. So, majority of people that come, they do yokes. When I first started, I did. You know, I blew accounts left, right, and centre when I first started. Not so much the business accounts, but my own accounts when I thought it was clever trying to trade small time frames. And I had to go through it. And it wasn't until I started applying common sense that I started moving forward. So that's it. So good stuff. I'm glad. I really am. Trading isn't hard, you know, guys. A lot of it is just, well, I just call it common sense, to be honest. The gambler, think of it this way. A minute chart can't show you anything apart from an entry. That's all it can show you. But you're sold on the fact that you can trade a minute chart. Well, where'd you get your idea from? You get it from high up the chart. Why up the chart? Because that's where the big boys play. So is it common sense to play, see what they're up to, and then enter downstairs? That's common sense. But most people do it in reverse. I don't know. Let's have a look. See what the questions are or whatever. I'm glad. Hello, Ivan. How are you doing, kidder? And Stephen and Frederick. Yes, Frederick, I still owe you a kick in the bollocks, but nah, you're a good kid. I'll keep on plugging for you. So, Yoks, let's have a look. Too big an amount on a trade because you hope confidence works and pay the risk. Yeah, you're pretty much right. I mean, what I would say about that is always know how much your trade is going to cost you. And I think there's a lot of people don't know. So that's it. And let's have a look. Yeah, right. Carl, I've just said 2% a day. Well, that's it. But the question, I suppose, when it comes to common sense is, do you stick to it, Carl? Can you stick to it? Because that's the other side of it. A lot of people can't. They might say, well, see, you got £1,000 you can sort of use this week, you know, and that might be your whole account, you know, because a lot of people do that. They'll go, right, I've got £1,000. But if you divide it up into 5 and one thing and another, at least it saves you blowing the lot. Because a lot of people will put 100% of the account on the line rather, and it'll just gone in a day or so. But if you actually only looked at, say, £100, well, when that 100's gone, stop, reset, do it again tomorrow, and you might get your £100 back. in the Scruffy Madness video that I did, that I think Lee's getting at, I showed what I did on Friday. I purposely closed off some trades knowing there were going to be losses, because I didn't want to take it into a weekend, because there's a high probability of a gap and I didn't want to be on the wrong side of it. So I was better off sacrificing to then fight another day. But if I was stupid, I'd have just left it running over the weekend, pray to God tonight it goes all right, and then worry tomorrow and see if I can get out of it. Isn't it better to sacrifice 20 quid and sleep dead easy and then carry on peacefully? Don't know. Who knows? Let's have a look, see what Lee had to say about that. I get the concept of splitting your trades up, buying at a discount, etc. What if the trade goes your way? No, not at all. The way Scruffy Madness is built is very similar to a banking system that buys your pensions. Because we're working intraday, the market will move a similar direction both ways. Now, if I'm going to run it for multiple weeks, I may add into a trade on the pullbacks, but during the day, I certainly won't. Because, and essentially what happens is, as you're adding in on intraday, as you're going to find the top of the market. And then actually the Scruffy Madness then works in reverse, because you're putting it in at a fuller price. And then when it comes against you, all the profit you made is gone. Scruffy Madness is working on the fact that you're going to have the market move against you before it moves for you. And it's the argument I have all the time. Oh, well, what if it runs for you straight away? So what? Then I just analyze that correctly. But that doesn't happen that often. It's more 7 or 8 times it will naturally move against you a little bit. And because it does that, I agree on the price. And then from there, that's it. That's how it wins. But it's hinging on 2 physical points. You need to know your point of entry and the point of maximum pain. And you divide up the pieces in the middle. But you need to know where you're going to get out, and you have to stick to that. If you're wrong, you have to stick to it. Because if you don't, well, all that happens is you keep moving the stop and eventually you blow your account up. And that's all about risk profiling. I really hate the term risk, simply because when you're trading, you should never risk anything. You should invest. Everything we do should be an investment. You know, I'm investing £100 to make whatever. And sometimes they go, oh, well, what about an inverse risk reward? Well, did you make more money than you, or have you got more money than you did when you start? You might have heard me say, start with 0, end with 1. Well, if I put £100 on the table and I made 10 quid, well, I made 10% of that 100 quid. Now, any business owner would say that's a good return. But in the trading world, they say it's a terrible return because it should have been 200 quid. Well, not really. It's all about up here and thought and management. That's kind of the way I look at it. Anyway, so let's have a look. Right, draw. Yeah. Chris has brought up a great subject, and Jan's kind of sort of chipped in on that as well. When you're in a drawdown, the psychology, like the mindset, psychology battle is horrific. It's genuinely one of the hardest part of trading, which is your mindset. Your strategy isn't your problem, guys. It really isn't. You can get in on the simplest strategy in the world. It's how you deal with that. And if you can't emotionally deal with it, you've got to have a hard stop. You've got to have a hard target and have the ability to walk away from the screen. Because what happens with your drawdowns in that situation is, one, you let it get out of hand and you panic. And because you're panicking, on the next trade, which you need it to work quite well to sort of start recovering some losses, you don't. What you do is you snatch at it very quickly. So your wins become small, but your losses become big, and it's a big mindset battle. So one of the easiest ways to tackle that is have fixed points. So you're getting in for whatever reason, support and resistance, cross of a moving average, whatever, and you know that's your entry. You need to know what your exit is. So personally, I like 2 barriers between my exits. So that can be 2 swings or sort of a swing and a support and resistance level, whatever it is, but I like to have 2. I know where I'm getting out, and then switch the P&L off or switch the screen off and then check it an hour later. That'll help you with your mindset, because you're not tempted to start fiddling. It's the hardest part, guys. It genuinely is the hardest part. But having 2 fixed points and don't move them is the easiest way to solve that. Where else are we up to? Revenge trading. Definitely redneck. Definitely. Because it compounds the screw up unbelievable. My rule is very simple. Score, score, stop. That means I win twice, I'm done for the day, because the third one will inevitably kick me in the arse. However, I also have another rule. If I lose on the day, I also stop. So I'm allowed 2 winners, but 1 loser. And what that does is, that stops the revenge trading, because you can be tempted to dive yourself back into it. But it also helps my mindset, because when I'm done, I know I'm done. Right, I've scored twice. I'm finished for the day. I'm going to go off, play golf, spend some time with Joanne. If I lose, it's the same situation, but I'm not going to get upset about it. I'm going to dial my emotions right down. See, when you're first starting, your emotional dial's 8, 9. Because I've done this a long time, mine's down to 2 and 1. If I lose, it's just a bad day at the office and I just walk away. But that's it. Simple stuff. So, HH, I'm not sleeping easy if I lose 20 quid. Right, but that goes back to mindset, HH. Because if 20 quid is making you tetchy, that means your position size is too big, or you're putting too much on the table to lose. And it should all be in relation to the size of the account, you know, or, well, you just don't like losing money full stop, which is an even harder battle to win, because it's inevitable. We're always going to lose money in this game. But your loss, well, I'll give you a good way, what I've told the guys many times. The number 1 question you ask yourself before you press the button, you should know roughly where you're getting in, and you should certainly know where you're getting out. They should be the 2 parameters you know before you press the button. Doesn't matter about your target, but you need to know what your entry is and your exit when it's wrong. And work out how much that costs on a full position size. So if you're £5, you work out what that is. If you think to yourself, I don't want to pay that, your position size is too big. So you half it. So for argument's sake, your £5 a point, it's 100 pips away because it's a big swing trade. 500 quid. Don't want to pay that. Right. So do £2.50. Will you pay £250 for it? Not sure about that either. Right, okay. Half your position size again, 125. See where I'm going? What you're doing is you're trying to find a point where you are happy. You go, right, okay, if I'm wrong, I'm prepared to pay that cost. That puts your mind at rest because you've already agreed to the trade. Now, as many of you know, I come from a business background, so I don't pay full price for jack up. I really don't. I'm used to negotiating price. So I want a better price for my full position. And I get that by breaking it up into Scruffy madness, into little parts. Now, if the first part runs and hits full target, great, I'm still getting paid, but my exposure was next to nothing. just meant it was only a little bit. If 3 of them run, well, my exposure is still less than 100%, but I get paid quite well. And if 5 of them run, fantastic. And that's how I control my mind. It makes life a lot simpler. So let's have a look. Where we're at. So 0.01 size per 100 risks. So 1800 might split 3 trades. What? 0.0 lot. Yeah, that right, I get you. Sorry. I read it wrong, Anthony. Yes, I work to a quick mantra. It's kind of £1 for every 1,000 or 50 pence every 500, or as Anthony's put there, 10p every 100. It's a very quick, easy way to work out your lot size. So if you've got £1,000 account, put £1 on. You know, that's as much as you can take. And then work it out and then divide it by however many splits you want to take. Makes life simpler. Right. Waldo, is there a currency pair that respects support and resistance moving averages more than any other pairs? They all respect them just the same. The difference is the speed of movement and velocity that they'll go to. You have certain markets like the Aussie dollar that is more trending. CAD dollar is more trending, so that lends itself more to a moving average, but they'll all respect levels. It just depends on which levels you've got on. Now personally, I think low time frame levels are, well, horrendous, to be honest. They just hold no weight whatsoever. So the only levels I ever use are monthly, weekly and daily. And because I use them, I know they're rock solid. So there's a fair chance that the market will respect those levels. And if it blasts through them, there has to be a good reason as to why it blasts through them. You know, was there a news event? Is there just a mass amount of money coming in? And these are the clues you need to be looking at all the time, and then follow the breadcrumbs and you'll start making some money. So happy days, happy days. So let's have a look. Oh, let's just missed out. Oh, just seeing Anna there. Hello, Anna. Very good. Very good. Glad you made it. Let's have a look. Many thanks for some of the great content, and you was very, very kind. I enjoy making them. Could you let us know if you were completely self-taught or you had the benefit of a mentor? A bit of both. My history into trading is slightly different than most people, because I had a mail order company that we used to import goods from far off lands. We had to buy currency in a form that was called forward purchasing. And in my office, I had an ex-commercial bank manager who worked for me. He was a retired guy, and he wanted another job, and I dragged him down to my level. And he taught me about the bigger money side of trading and how levels are important, daily charts, etc. And that's where my trading came from. But then as time moved forward and I wanted to start moving more into day trading than investment trading as we were doing, it was a case of trial and error and self-taught over many, many years. I'll kind of quite tell you how much I've spent, but let's just say it's a lot, because I went on various banking seminars, courses, this, that and the other. And a lot of it's just recycled garbage, to be honest. The markets aren't that hard if you apply common sense. And that's the first rule that I learned. And then from there, it's how you control your psychology, as the guys who are on the top. So did I have a mentor? Yeah, I did. Jim Barton, probably the gentlest human being I've ever met in my life. He was a wonderful guy. And he taught me a hell of a lot about not so much the markets, but how to apply yourself as a person. And that resonates in the market. So if you can be calm and treat it with respect, then you start to understand it a little bit better. But can you do it on your own? You can. Can you do it from just watching YouTube videos? Not really. It's too much noise. And if you go into some forums, there's way too much noise. If I was to boil it down, get your levels in place, pick a direction and stick with it. And stick with it whether you're right or wrong. Second you start trying to second guess the market or trying to work out what's going on, you're probably going to overcomplicate it. And that's where the problems lies. Keep it as simple as possible and you'll be fine. Think about it this way. You got a level here, you got a level down here, and the price is in the middle. You're already at 50-50. Why is that? Because it's going to hit one of them. Question is which one? Then look at the basic trend of the market. If it's moving up, it's moving up. Right, the odds are in your favor. And that's what you're doing. You're stacking the odds in your favor. And is it going to move against you? Most definitely. So capitalize on that as well. Put your toe in the water and edge the trade backwards to a decent price. And that'll help you. It genuinely will. So where are we at? You wanted to follow a run past your target and a safe way to trail a stop. There's many ways to trail a stop, Yoks. You can just do it with a pip count, or you can trail it behind a moving average, a level. Give me a second, I'll show you something. Get rid of that. You can do a candle bounce. If you don't know what a candle bounce is. Point to point. Let's get a point to point. Just run it behind a candle. So you've got a candle here. You know you've got an exit point here. So that comes up, close. That one closes. Right, okay, I'm going to move that up to there. Let that one run, closes. Move that one up to there. Just bounce the candles underneath. The trick with that is let the candle close. Simple way of doing things. Another way, just whack everything on. Just get rid of these for a second. Drop your moving average on. Whatever your chosen moving average is. There you go. You just trail it behind that till it hits your target. Simple. So that's a simple way. The other way is just, as I say, simple pip count. You know, you trail it 20 pips behind the price and you'll get extras. Now, during intraday, I like to be a target trader. In other words, I like a point that I'm going to get out. And where I'm going to get out is a level. That's simple. Okay, so where are we up to? I'm sorry you're late. Not a problem. Not a problem. And let's see. Caught up to Anna as well. I saw it earlier on. Caught you the other day. You did well on the live stream. You really did. Keep on trucking. Hello, Aziv. Addy cool. Right, SB. Oh, I'm so glad you're here because you comment so much on the YouTubes. I want to give you a special little salute. Happy day. So many comments and so many questions. And mind the language barrier in the way. But don't be quiet, SB. You shout as much as you like. I'll be swearing and drinking as I normally do. So let's have a look. See where we're at. Losing 20 quid is either big or too frequent. Yeah, right. Well, that comes back to what we were saying earlier on. I mean, I stick to score, stop. I genuinely do. And I'll just kind of get rid of that. Wow. Score, stop. It is a very simple way of controlling yourself. I know how much I can lose per day or how much I'm willing to spend per day. I should really stop saying lose because I think it's the wrong terminology. So that's one thing. If I do that in one trade, then that's it. It's game over. But I know I can't outwit the market indefinitely. So it's score, stop. So win, stop. But I also have a third one. If the first trade hits my salary for the day, I'll also stop. And all of this, what this does, this compounds how you perform, you know, and it keeps my win rate very high because I'm not trying to outwit the market. I just want to get in on a decent setup, get paid, get out. And that's it. So that helps the win rate. But if I'm uncomfortable with the cost that I'm going into the market, that might make me make a silly choice. Well, if I'm making a silly choice, then I might fiddle with it. And if I fiddle with it, then I'm going to make an error. And it's these errors that hurt us. So tonight it is literally about the mindset side of it. So good stuff, guys. Good stuff. Keep it coming. Right. Kendall. It's a new name. How'd you do? You want to say thanks for simple trading system over the years? Well, I've done this a long time and I really, really appreciate that. To be honest, if I flick this back over just half a second and I take this off, if you look at this chart and I showed you that, most people would freak out. They genuinely would freak out. They'll go, what the? I nearly swore there, boys and girls. I nearly did. But I've noticed there's ladies in, so I'll have to be quiet, but I'll have a drink just a second. Because I'm a brute. Right. If I showed most people that, they would freak out. They'll go, how the hell am I meant to trade that? If I showed them this, they would freak out. Okay. Well, if I change this over into the way I like to trade, which is on standard candlesticks, a good way of holding a trade going back for Yoxie actually is trail your stop, because I should have told you this because it was what I was doing on Friday. Trade it behind a Heikin-Ashi, because a Heikin-Ashi doesn't change color. As long as the color stays the same, it'll hold you in the trade. Touch on that in a minute if you want. If I show you that, you would freak. But if I come down to a trading chart and I start showing you this, this looks a bit cleaner. But this is only where I'm getting an idea from. This is showing me trading arenas. Trading arenas are from a solid to a solid. And then you've got hypothetical points in the middle that the price will respect to. Now, all of these levels are driven from a monthly, a weekly, and a daily. That's the only levels that are on this. But if you take this all the way down into an entry point, you have clean trading arenas that have defined points of attraction here, here. And if you look at the way the candles perform, even if you take it right into a 5 minute, get rid of this, you have clean entry points all over the place. And all you're looking for is simple breaks on a chosen direction. Now, you might look at the market and think, I think this is going to be up all day. So all you do is look for long. Well, very simple. Why am I looking for long? I want to see a level break and I want to see 2 breaks above it. 1, 2. There's an order point. Simple as it gets. Does it matter that that one's red? No, because the price has to come to you to get into it. Gets in, wallop, straight up. Look for a basic target of around 10 pips, 20 pips, whatever your chosen target is. There you go. Bang. Catch it. Down here. 1, 2. Sit goes up. Does it hit your target on the second one? Let's have a look. So 1, 2. So it'll be above there. There's a 10 pip target. Oh, it didn't go. Had to sit through some heat. Bang. Got my trade. But if I were doing Scruffy madness, I could go into this, down to there, because there's a barrier, there's another barrier. Scale in, boom, got a big trade. Trading ain't hard, guys. It really isn't hard. Keep it as simple as you can. Pick your direction. Know where your entry point is, know where your pain point is, and work from there. Simple. So let's have a look, see what else we've got. Very welcome, Phil. Very welcome. My system gives me a go and I don't have to doubt anything about it. Very welcome. Very welcome. What I will say is if you've got a system in place, whether it's similar to mine or whether it's some other, because all systems work, believe it or not, guys, they all do. The difference is the conditions you're going to work them in. Now, if you're using a moving average sort of system, by nature, it has to be a trending market. The way that I work, because I'm working from a Z zone to the next zone, doesn't really matter, because I want to get in, I want to get out. But when I'm swing trading, I'm looking at the river, I have to go with the dominant trend. Nature of what it is, because I can't tell you what's going to happen next week. You know, I could be in for that trade for a number of weeks if the trend's pretty strong. And again, moving averages will help that. So let's have a look. So Chris, can you give us a quick example of what you do? Totally new. Well, I'll just give you one, Chris. So I was ahead of the game there, ahead of the game. Basically, what I do is I move from level to level. That's it. It's as simple as that. There are certain criteria that I work to that are sort of given to the squad, but the essential essence of what I do is I read the market fully on a morning to pick the individual asset I'm going to trade. That's done through strength. I want to see a weakest and a strongest fighting against each other. I'll also look at those currencies to see which indices is good, because as I was touching on cable and FTSE and gold, there are correlations, so it can help me decide which indices I'm going to look at as well. Although saying that, the DAX will move every single day. I'll always find an opportunity on the DAX. I'll mark it up, as I've just shown you, with monthly, weekly, daily, and then I work from one arena to the next. And it's as simple as that. Absolutely as simple as that. Okay. So, have you ever come across any other traders that trade your way? Scruffy Madness way? Yeah, most professional traders. Scruffy Madness is nothing new. There's another version which you might have heard of, which is called the Martindale system. And some people confuse the Martindale system with what I do. It's not. The Martindale system is where you put £1 on, goes against you, you put £2 on, goes against that, you put £4 on, then 8, and you're doubling up all the time till the market eventually turns round and then sort of either pays off all the losses or gives you a profit. The trouble with it is you need massive pockets. And if you're in a trending market going the opposite direction, it will literally obliterate your account in one go, because you just can't indefinitely double your account or double your position size. It's very, very dangerous. But there's another discipline which is called pound averaging. Now, pound averaging or dollar averaging, depending on how you want to look at it, is the way most professional traders will trade, because they know they're not going to get in 100% on point of entry. So what they do is they break up their positions into bite-sized chunks, but they're also staging to get better pricing as well. And that's where it came from. Now, the point of difference with Madness is it works on 2 fixed points, rather than X amount of money is going to be divided into the market as, say, a pension fund would work. You need an entry and a maximum pain threshold point. And then from there, it's divided up and you add equal amounts as it goes. And then eventually when it hits the bottom, well, if you're wrong, it hasn't cost you as much. And that came from professional traders that I'd spoken to in the past. And then I adapted it to what you see today. So there she is. Nah, she's upstairs watching telly. So happy days, happy days. So where we are? Where are we up to? Where are we up to? Tama, any chance you could have a brief look at US tech as it's breached the 50-day and looks like we may be going back up? Well, let's have a look at it. don't make predictions on it till I actually see the opens, but let's have a little look, shall we? Okay, strip everything down if you're looking at fibs. All right, let's have a little look at this bad boy. All right, it's currently turning on the monthly. Doesn't see anything, but let's see why it's turning on the monthly. Have a little look at this. See where this started from. The move of that probably started in around this area here for the last accelerant. I'll explain that. If you look at the market when it's quite flat, it's only just grinding away. The way fib works is best if you find an accelerant. If you don't have an accelerant, the ratios don't really work. It's grinding. But there was a move heavily to the downside, starting a new upshift here. Okay, so it sold off for 4 months and then wallop, off it went. And it did try and come back. So you could even start it from there as well. But I want to look at the bigger term picture. So I would start that probably about here. And then if we look at how this is working. So there's the 50, which you can see is the stall point. Just here. It's coming back to the 38, which is there. And if we go back over to here. Now again, when you're looking at the way fibs work, this is actually a good illustration. Just take that off. I'll explain why that is. There's your accelerant. It's come down and it stopped dead on that 23. Boom, 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 boom. Broke through, stopped dead on the 38. So there's your trading arena working its way to the 50. So you've got plenty of opportunities to sort of have pending orders sitting waiting to move from one to the other. And then it hasn't made it to the 61 because the 50 is the pivot. Go to the weekly. Right. The downshift is here. We can see it. You can see a definitive top. You can see a definitive bottom. Clear as day. There and there. The first candle of the move is this one. It's always the first alternating color. So if it's going down, you're looking for the first red one. Well, it's there. I would say that shift started there. Try to come back up and then collapse. Boom. So it's roughly around this area. And then how far it goes down, well, it's just as far as it goes down. This now gives us some more levels that we can look at and understand. Now, I'll only just put in the ones that are relevant. So it's there. And then we'll take it down into the 50 and then we'll see what it looks like on an hourly. Okay. 38. And the 23. Okay. So, again, look at the way the fibs have started to react. Store, 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 store on the key fib areas. Okay. I'm just going to draw a quick line on there because I don't want any fibs on this side. I want to see if there's any dailies on this side. Flick that across. Tighten this up. Got a bit of chop. Massive down. There's the drive. That's it there. So we can see the base. We can see the top. Okay. Fib retracement started probably there. Got as high as there. Okay. So just drop these in. And then we can see where we're doing. Talk amongst yourselves, guys, just while I fill these in. All right. So what this has done, this has given me a little bit of a framework of what's going on. Okay. Now, the retracement, it's come down, stalled, 23 into 38, but failed the 50, but it had a right good go at it. And it's moving back up. The question is this just a retracement of profit taking? to move to the higher points, or is it an actual reversal? Drop it out to the weekly. Let's have a look. Let's find out. Well, it's broken the Bollinger. The Bollinger's collapsing in. Okay. If it's been on that side of the Bollinger, it's going to want to try and come back to the other side. It's the daily sale. Well, it's pushing down. It's at a key level. So this can push possibly as high as here to come back down. And why? Well, it's not quite there yet. Let's see. Down into the hourly. That is excessive. Absolutely excessive. And you can see that clearly. Now, what else can we see? We can see a collapse here. Now, that's telling you the pressure's running out of this thing. So if it is going up, the first stage is going to be here. Then it's going to look to try and get here. But I think that'll be the ceiling it would get to. I definitely do. Now, are there ways you can work this out? Well, there is. You can start looking at extensions on this. Let's have an extension on it. But you want an extension from a completed area. I'll move that back down, push that through. Let's have a look at these extensions and then have a look at this maybe tomorrow. And what these do, if you bear with me while I just drop these in, because I might watch this myself tomorrow. Okay. What I've done here is I can see that's a completed leg. All right. Definitive low, definitive high, it collapsed, failed, broke the top and kept on going. The extensions can now show me how far this will go. I've already established from a higher point that this can get to here. There's that extension, 261. Run it through, well, what do we know? It's the bottom of the cluster of here. So that'll be the first barrier. That's collapsing in. So maybe that might catch up. So this arena here is probably the max point it's going to get to before it reverses back on itself into these. So if I'm looking at this tomorrow, I wouldn't do anything with this till it got here. Then I would make a decision. Now, if I want to dig into this a little bit deeper, and I want to see what's going on, well, I can see it's completely overstressed. I'd be looking to sell this around here to come back on itself. That's the way I would break this down, because everything's telling me that it's stressed. It's stressed here. I can see the stress point here. I can see a key level here. If I drop this back over onto a 4 hour, sure enough, that balances up with that flare. So to me, that's the area of execution. And that's the way I would break it down, and then I would stick to the conviction. I hope that makes sense, guys. I genuinely do. But that's how I read a market. I look for the stress points within it, and then I'm looking for a reaction at that point. Now, in this case, I just use fibs, but I would like to see solid levels put into it as well, and then build it up. And then if I've got an idea, a conviction in my mind that I think it's going to retrace, I would then look at that and then look to capitalize on it. Hope that makes sense. Genuinely do. Okay. So, 𝗖𝗢𝗡𝗖𝗧. I hope I haven't screwed your name up. I'm just learning your entry scaling method. I understand you are taking partial trades when trade moves against you, but do you ever take partial trades as it goes straight? Do you mean, do I scale into it? I was talking about this a little bit earlier on. I only scale backwards. I don't scale into it. But what I do is price jumping or price bouncing. And it's normally on a very, very fast market. where, like the DAX for argument's sake, I'll let it run maybe 15 pips in my favor. I'll take so much of the trade off, knowing it's going to come back on itself, because it does that all the time, you know, and I'm going to capitalize on that as well. So I'll take maybe, if I'm on £5 a point, I'll take £4 off when it hits 50, 60 quid, puts that money in the bank, it leaves a pound running. If it runs back to within a couple of ticks of where it started, I often put the order back in, and then you'll see it getting built up like this. And then eventually I've got loads of £1 positions, which pay me quite well, but I've already had money off the table as well. It's quite a difficult thing to do, and you get used to it after a while. But it only works on very, very fast markets. If it's on something like euro dollar, it's just a case of suck it and see. Happy days, happy days. So where we are? Don't you worry, Princey. Everybody's doing well. I was just filling time till you got here. Generally was. There is big news, and there is NFP on Friday. I forgot about that last week, actually. I genuinely thought it was Friday gone, because I'm so used to it being first Friday of the month. But obviously February is a short month, and it throws out the economic calendar. And anyway, it's on Friday. But yes, there's lots of news this week. That's another thing. Be very careful of the news, because when you're trading the news, it's unpredictable. You know, my advice is let it happen and trade the aftermath if you're day trading. If you're swing trading, make certain your stop is in a very safe place, or if you're very close to the price, just get out. You know, you're better off taking a hit for a few quid and re-entering than just watching the thing race off and get yourself a margin call if your account isn't big enough. The news can be pretty brutal at times. Fashionably late. Finny, what are we going to do with you? Are you still crying because of the football soon? I bet you are. I'll have a drink for you. I'll have a drink for you. Mano, why do I avoid trading the UK Open? Is it not the time for maximum potential opportunities? In a word, no, it's not. It's the time for gamblers to sort of try and second guess the market and lose their money. It's a dumb time to try and trade, simply because you don't know which way the market's going to go. Inevitably, the market will go the wrong way before it goes the right way. And if you're looking at the market and you think it's going to go long, it's the time where the big boys also know you know that, and they'll use that against you. I'm not a fan of the Open, and a lot of the big players that I know, they avoid the first 30 minutes like the plague for that exact reason. But the newbies and the guys who chase money, and it's up there, you chase money, you lose. And I'll say this to everybody who's watching this, and I know I'll get it kicked into me because I do every week. If you're chasing the money, just give it up, because you're never going to get it, because you'll gamble. And as soon as you go down that route, you've lost. Follow a process. The money is the byproduct of doing a good job. And a good job is knowing when to trade and when not to trade. And I know the Opens, well, only the UK Open, because the American one isn't as vicious as you think it is. But the London Open is literally a widow maker. It can really knock you on your backside if you're not careful. So you may like the DAX, but you're not quite on top of your nemesis yet. I'm not on top of any of them yet, redneck. My edge is knowing how to get out of trouble. It really is. But yeah, who knows? I might trade your little favourite Tech 100 since we've had a look at it this week. And you're right, it is the nemesis, but the true nemesis is USJPY. I did take it on the other week, as you saw, but I genuinely dislike that market. For no other reason than psychological. It's the one that's burnt me a few times. So, anytime, Sam. Right. D. Do we pay any more in spread if we split up your trades on the same spec? No. Because it's based on the cost of the size. It's just in relation. So if you go 100% to market, it's pretty much exactly the same as breaking your trades up. But again, it comes down to account size and whether you're willing to take the trade on in the first place. But no, it shouldn't cost you any more. How to be a consistent trader? Less is more. Quite frankly, if you overtrade, you're kind of putting yourself in front of the freight train a lot. Have a single system, whatever it is, doesn't really matter, but have a single system and then analyze your market to see if it fits that system, and then trade once or twice a day. The market will only give you 2, 3 opportunities a day. Any more than that, it's pushing the limits. And that's it. That's how you become consistent. If you're trying to be in and out the markets all day, it never works. It really doesn't. So Kevin, when you draw your fib lines on the chart, do you remember the figure the level is at? Or is it the fact? Well, the only one I'm really interested in, Kevin, is the 50, which is the pivot. And I normally know exactly where that is. But I also know the direction that I'm working in. So if I know where the 50 is, I already know where the 38 and the 23 is, which is just habit. Another way, you can always put labels on the levels as well. But it depends on what I'm doing. If I'm doing retracements, my entry is 23 to be risk-free at 38 and sort of out by 50, or leave a little runner by 50 to see whatever happens. That's a retracement. If I'm going with the greater trend, then what I'm looking to do is I'm looking to see breaks of the same levels, the 23, 38, 50, 61, and then I'll put the order above it so it has to do a rounded retest in order to take into the market. So it's more a level of interest than a number. If that makes sense. Oh, it's a dangerous thing to say that. Should we turn off stop losses during CPI? Well, my advice is just don't be involved in it in the first place. My answer would be no. Don't ever turn your stop loss off, because a CPI can run massively and it can move so fast and so far. If your account is just like a normal account, you'll damage it massively if that thing keeps on running. And not only could it and the worst thing that can happen is you'll get your margin call, and that damage will be taken from your hands. It'll just shut off. Your best bet is read your economic calendar during the day. If you know the news event is coming, make certain you're out. You know, don't get into it. And that's my advice. If you're swing trading, I would still leave my stop where it was, because I'm just accepting the consequences of the trade. And that's what your stop is. Your stop has one job, just one, and that is to protect the account. You know, if you start switching it off and fiddling with it, then you've took its job away from it. You're trying to second guess the market, and that's where the trouble starts. So once your stop's in, leave it be, you know, and just accept what happens. But my advice, don't trade it in the first place. Okay, so we'll do the last couple of questions and then we'll wrap it up for tonight. Monnery, could you just go through how the Bollinger Bands play on the US is distressed? All right, I'll do that quickly, because otherwise I'll be here forever. All right. When you look at a Bollinger Band, a Bollinger Band in essence is showing you the pressures and the volume of the market. If it's nice and wide, there's a lot of volume coming into it, because if you can imagine it's being pushed out like this, you know, somebody in a bag and they're pushing out. That's what a Bollinger Band is. Now, as it gets to the upper sides of it, sort of like these here, it's pushing the edges, and it's like an elastic band. Eventually it'll just go boom, it'll snap back. And that snap back will cause a retracement. And the retracement will first revisit a moving average. And as you can see in this sort of example, it pushed out, you know, it went out, came back, went out, came back, and eventually it couldn't hang on to it anymore. But what you're looking for, the telltale sign, is this, the curl at the top. All right. Now you can see one forming here underneath. If I switch the drawings off, be able to highlight that for you. You can see one curling here. All right. So what that is, that's telling you pressure's running out. So if it's running out, then okay, you know it's not going to go into a run. It's going to run up and it's going to bounce. Now here, you can see it's flaring up the side and it's starting to close and it's running out of steam. And you can see that because it isn't all green. It's going up, it's stalling, it's pushed back down again. Pushed back down again. And then eventually it can't do it anymore. Wallop, down into the moving average. But when it tried to push back up, it can't get to the top. And that rollover is showing that. Okay. Happens time and time again. Here it pushes up, pushes out, comes back, tries to push up. You can see the rollover and then it collapses. Boom. Well, that's happening here. Okay. Now the other version, what you want to be looking for, if I can just find a nice example of it here, is something like this, where it pushes up, but then it runs into a sausage situation. All right. Well, when it runs into a sausage, then there's going to be a big move. In other words, a consolidation. It can help you see the breakout. See if there's a one where it'll flare. Possibly not. See how it moves that way, like so. So my drawing's back on. I'll be able to draw it in for you. Just take all of these off. Now an easy way to do that is this. See, it's flaring that way, and now you can see it's flaring that way. So now what you're doing there is you're going, right, okay, this has a high probability of a bigger move. Why? Because it's flaring out. You can see the pressures coming in. Now, can you use this on its own? Not really. But what it'll do is it'll start showing you where the bend points are, and what you'd look at is something like this underneath, an oscillator of some description. So it's burst out here, but that hasn't burst out up here. Okay, so there's plenty of movement, and you can see that's starting to flare. So it flares, 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 and if I drop on a line, just where it starts to collapse, all this is overstretched as well. Well, if there's a level up here, you've got 1, 2, and then say a level, there's 3 bits of confirmation that it won't hold, and then wallop, down it comes into a bigger move. And it's just piecing the puzzle together, little bits of breadcrumbs here, there, and everywhere, and that's what you're looking for. So the first thing I would do on a morning is I would look for a dominant direction, and then I'd look for the clues inside that direction and stick with it. And it's, a lot of people call it smart money concepts, all of that sort of thing. It's just being common sense. Oh, Trader Nick, how are you doing, kid? I must catch up with you, actually. Hope you're well. You've come in as we're finishing, but I was just killing time till you got here, kid. How are you doing, lad? How are you doing? Right, let's see where we're up to. But that's kind of a watered way, Mano. And like I say, when we do this again, just shout and we'll kind of go through it a bit better. Peter, you are so right. CPI, the market will rocket like there's no tomorrow, as will non-farm payroll. And to try and second guess it and try and hold your stops and things like that, it's madness. Just let it do its thing and then trade the aftermath. You'll be fine. David, that's a lot easier. You're not kidding, because there's nothing worse than getting somebody's name butchered. But then again, anyone can call me whatever like. Right, would you mind quickly showing how those key levels monthly, how you do those key levels monthly and if it's too complicated. Well, in the squad, drop down into where the scruff, and you'll see trading arenas. I'll drop you a link for it, dear, because we kind of run out of time. Well, we ran out of time 20 minutes ago. But I'll drop it back on, and I'll quickly give you an idea of what you're looking at. Basically, just get rid of all of these indicators. If you're going to mark a chart up, all right, it's very difficult to sort of pick out the tops and bottoms, etc., with the candlesticks, because, well, they all chunk together and one thing and another, and it gets a bit difficult. So wherever you're going to draw them from, now personally I only do monthly, weekly, daily. I'll drop it into a line chart first, and what I'm looking for is the absolute apex of the term, like that. And if you can imagine, you can prick your finger on the top of it, that becomes a good point. So just to give an example, there, they're like teeth. But if it's just a kink in the road, I'll give you an example of a kink in the road, like that, it's not really holding any weight. So what we're looking for is points like that, just like so. And then underneath it, you'll see another one, just like so. And then it runs through. But these are what we're looking for, these V formations. And if you ran it down, oh, in the squad, I'll show you exactly how to do that. There you are. That creates a nice arena, and then it pulls back up. Down. And that's what you're looking for. It's how you mark it up. It's an easy way to mark it up. I can spend about 10 minutes marking a chart up fully. Okay, so, but that's the quick and easy way to do it, guys. The quick and easy way to do it. But like I say, we've run out of time to start doing full markups. I'll just answer these quick questions, and then we'll kind of wind it up a little bit. Okay, what's the best time to look for entries? Well, I look at the top of each hour. It's how I work things out. So I'll come to market. So say it's 9 o'clock in the morning when I start. I'll check to see if the conditions are ready. If they're not, I'll wait for another hour. And then at 10 o'clock, let's say the conditions are correct, drop it to a 15-minute chart and see if the conditions are correct on a 15. If they're not, well, then I've got 4 15-minute closes inside of that hour. And it might take me 2 or 3 of them for it to come into play. And then when it's in play, drop it to a 5-minute for an entry, and then manage the trade thereon. And that's kind of the quickest and easiest way to do it. There isn't a definitive best time. What I would say is there's good times to avoid rather than enter. The opens can be vicious, and they can spook you out of a trade, and they can certainly catch your stops if you got them too tight. And news events, again, for the exact same reason. So let the dust settle, and then trade from there on. So there we go. I've joined a signal system, and the guy is running, seeing 900 returns over 90 days on backtest. I've seen the proof, however. Okay. Good luck with that one. But if he's doing 900% returns in 90 days, and it's absolutely legit, every bank on the planet would want to talk to this guy. Every single bank. Everybody who knows me knows I don't like signals. I think they are fool's gold, and that can lead you up the wrong path. You're best off learning to trade for yourself, and then be in a decent community, and then have shared ideas. Now, that's not a signal service. That's just an idea of, oh, I'm looking at cable, it's good, I quite like this level for whatever reason. I think the market's going to do X, and then you make your own choice. Then you're master of your own destiny. But if you're on a signal system, and it's too good to be true, the chances are it's not. But also, what happens if they shut down and they are that good? You're left high and dry. You've got nothing else to back up on. And then there's another element. If you're not running the exact same platform on the same server at the same time, they might be saying get in at X level, but your level on your broker might be slightly different due to the market maker's setup. So personally, I think it's pretty dangerous, kid. Hello, Ron. Lovely to see you, my kid. And that's it. And then finally, Carl, thoughts on the new 5% setup? I need to dig into it a bit more. I did speak to them about it on Wednesday. First thoughts on the new instant side, I quite like it. I think it's a good way to calm traders down because of the cool down point and the way they're going to stage it. Value for money, I still think it's pretty darn good. As for the high stakes, I need to dig into that a little bit further because I'm not into the gambling side of the trading world. And I certainly don't like quick time frames in the trading world. I think you should trade at your own pace, and slow and steady is the way forward. If you try to do it in a very fast period of time, it kind of breeds gambling to a degree. It's kind of why I don't like the FTMOs of this world. I'd need to dig into that one. But the instant one, where you've essentially got a year to pass it, well, I think that's fine. And when I look at the figures on it, they stack up. They're pretty good. So happy days. And yeah, David, I'll drop a link to it on the chat. Just exactly how to mark it up. It is markup Monday tomorrow for the squad anyway. So I'll be doing a full markup in the Zoom call in the morning. But there's also, if you look at the replays, I've already marked up the key products we're looking at this week, so you can see me mark it up in front of you. Hope that helps. Anyway, guys, there we go. Been banging on for God knows how long tonight, because we're well over as normal. I hope it helps. I genuinely do. We'll do this again next week. If you can't make it, just drop me a question on the email and I'll answer it first, and we'll try and sort of clear things up. And have a good night, because I'm going to enjoy my beer. And it was lovely to see Trader Nick dropping his head in. Happy days, kid. And Anna, wherever she is. Can't see her on the chat anymore. It's gone too far up. And for all of you for attending. Great stuff. Watch how you go. By the way, the daughter thought you were called Smelly Trader. My daughter calls me Smelly Trader. Little cow that she is. Okay, boys and girls. Have yourselves a great night and keep safe this week. See you all soon.